Most business owners think that their CPA has their tax strategy handled. Then they die and their family loses 40% of everything to taxes that could have been avoided. I've helped hundreds of business owners in the Carolinas protect over 50 million from unnecessary taxation using trust most people have never heard of. So in this video, I'll show you the exact trust strategies that keep more of your wealth in your family and out of the IRS's hands. Here's something your CPA probably isn't telling you. The step-up in basis is one of the most powerful wealth transfer tools in the tax code, and most people screw it up. Let me explain what I mean. When you die, the IRS resets the cost basis of your assets to their current market value. If you bought a building for $200,000 and now it's worth $2 million when you pass away, your kids inherit it at $2 million. Zero capital gains tax if they sell it. That's a $450,000 tax savings. Just gone, erased. But here's the thing, this only works if your estate plan is set up correctly, and most aren't. I've seen families lose hundreds of thousands because they used the wrong type of trust, or worse, no trust at all. So let me show you how this actually works. A few years ago, I had a client, let's call him David. It's not his real name, obviously. David owned 3 commercial properties in Charlotte. Bought them in the early 2000s for about $800,000 total. By the time he came to see me, they were worth $4.2 million. He was 58, healthy, successful, and he had nothing. No estate plan, no trust, just a will from LegalZoom he printed out in 2012. CPA told him, "You're fine, you're under the state tax exemption," which is technically true, but completely missing the point. Here's what would have happened if David died without fixing this. His properties would go through probate, his kids would inherit them, and if they wanted to sell, which they did because none of them wanted to be landlords, they'd owe capital gains tax on $3.4 million worth of appreciation. That's over $680,000 in taxes, just gone. So what we do? We set up a revocable living trust. Took about 3 weeks, cost him about $5,000. When David passed away, 2 years later, of a heart attack, which was totally unexpected, his kids inherited those properties with a stepped-up basis of $4.2 million. They sold them 6 months later, zero capital gains tax. We saved his family $680,000 with a simple trust structure. That's the power of planning ahead. So let's break down trust strategies that actually move the needle for business owners and high net worth families. I'm going to give you 5 lessons I've learned after setting up hundreds of these plans. Lesson number 1. The step up in basis is your secret weapon. Most people think trusts are about avoiding probate. That's like buying a Ferrari and only driving it to the grocery store. The real value is tax planning. Here's how the step up in basis works. Under IRS Revenue Code Section 1014, when you die, your assets get revalued to their fair market value on the date of death. This applies to real estate, stocks, business interests, pretty much anything that appreciates. So let's say you bought Amazon stock. Good on ya. In 1998 for $10,000. It's worth $500,000 today. If you sell it while you're alive, you owe capital gains tax on $490,000 worth of gains. It's about $98,000 in federal taxes, plus state taxes, depending on where you live. But if you die and your kids inherit it, their cost basis becomes $500,000. They can sell it the next day and owe zero capital gains tax. Now here's the key. This works whether the asset goes through probate or through a revocable living trust. The trust just makes sure that your family doesn't have to deal with court delays and public records, but you still get the tax benefit. Most CPAs know this rule exists, but they don't build estate plans around it. That's why you need an attorney who actually thinks about tax strategy. Lesson number 2, irrevocable trusts are for removing assets from your estate. Okay, so revocable trusts are great for probate and step-up planning, but what if your estate is big enough that you're gonna owe estate taxes? Right now, the federal estate tax exemption is about $13.99 million per person. It's adjusted for inflation every year. So that's if you're married, that's close to $40 million combined. That sounds like a lot, right? Here's the problem. That exemption is set to get cut in half January 1, 2026. It's going to be back down to around $5 million adjusted for inflation, which means about $7 million per person, unless Congress changes the law. So if you own a business worth $10 million, a house worth $2 million, and some investment accounts, you could be over the limit, and the estate tax for what you're over the limit is 40%. That's brutal. That's where irrevocable trusts come in. An irrevocable trust removes assets from your taxable estate. You're basically saying, I'm giving this away, I don't own it anymore, so don't tax me on it when I die. There are a bunch of different types, but here are the 3 I use most often. GRATs, grantor retained annuity trusts. You transfer an asset into the trust, and the trust pays you back over a set number of years. Any appreciation above the IRS's assumed rate of return goes to your heirs tax-free. This is how wealthy families transfer stock and business interests without using up their gift tax exemption. IDGITs. On top of being really fun to say, it's an intentionally defective grantor trust. It's a weird one because the trust is defective for income tax purposes. What that means is you pay the income taxes on behalf of the trust. This lets the trust grow faster because it's not losing money to pay taxes every year. And because you're paying the taxes, it's like making a tax-free gift to your heirs. The IRS allows this for now. SLATs, spousal lifetime access trusts. This is good for blended families, definitely. You create an irrevocable trust for your spouse. The assets are out of your estate, but your spouse can still access them if needed. It's a way to get your assets out of your estate without completely losing control. Now, these are some very advanced strategies. You need a good attorney and a good CPA working together. But if your estate is over $10 million, this is how you avoid getting crushed by estate taxes. Now, huge caveat. This is technically incorrect because as of July 2025, when Trump passed the big, beautiful bill, he codified the federal estate exemption amount to be $15 million per person in perpetuity forever as of January 1, 2026. And it's never going to go down. But I think we all understand how the government works, and when there's a new POTUS in office and they're maybe on the more liberal side, maybe they do change that and it goes back down to what it was in my example before, or to what it was in the beginning of the 2000s when it was $500,000 per person. The point of me telling you this is, although the example I just went through is technically incorrect currently, in the future you could find yourself in a very similar scenario where you definitely should be using exactly all of the examples I went through previously. All right, lesson number 3. Charitable trusts let you avoid capital gains and get a tax deduction. Here's a move I love for clients who are charitably inclined. Let's say you own a piece of land you bought for $100,000 and it's now worth $1 million. You want to sell it, but you don't want to pay $180,000 in capital gains taxes. Enter charitable remainder trust, and actually, fun fact, we call it a CRUT, even though there's no U. How that works is you transfer property into the CRUT, the trust sells the property. Because the trust is a charity, it pays 0 capital gains tax on the sale. The trust then invests the proceeds and pays you an income stream for a set number of years, or the rest of your life if you like. When you die, whatever's left goes to the charity of your choice. You get 3 benefits: no capital gains tax on the sale, an immediate charitable deduction when you fund the trust, and income from the full $1 million, not just the after-tax amount. And the asset's out of your estate, so no estate tax either. Now, if you want to benefit your kids instead of a charity, you can flip it and use a charitable lead trust. The charity gets the income for a set number of years, and then your heirs get the remaining assets. This reduces your estate taxes while still passing wealth to your family. Both strategies are legit. The IRS loves them because they encourage charitable giving, and you love them because they save you a fortune in taxes. Lesson number 4, life insurance trusts keep your death benefit out of your estate. Most people think life insurance is tax-free, and to be honest, it's sort of true. Your beneficiaries don't pay income tax on the death benefit. That part is true, but if you own the policy, then the death benefit is included in your taxable estate. So if you have a $5 million life insurance policy and your estate is worth $10 million, your taxable estate is actually $15 million. If you're over the exemption limit, that $5 million policy just created a $2 million estate tax bill. That's insane. The fix is an ILIT, an irrevocable life insurance trust. The trust owns the policy, not you, so the death benefit isn't part of your estate. Your heirs get the full $5 million tax-free, and it doesn't push you over the estate tax exemption. You can fund the premiums by making the annual gift exclusion, which is right now $19,000. You make that gift to the trust, and if you structure it right, you can even pay the income taxes on behalf of the trust, like an IDGIT, which lets the trust grow even faster. ILITs give you control over how your beneficiaries receive the money. You can protect it from creditors, divorces, and even bad financial decisions. If you have a large life insurance policy, then this is a no-brainer. All right, last one, lesson number 5. Valuation discounts let you transfer more wealth using less of your exemption. Here's a strategy most people don't know about. If you own a business or an investment property, you can often transfer it at a discounted value for gift and estate tax purposes. Here's why. Let's say you own a business worth $10 million, but you only own 40% of it, and you don't have control. The IRS allows you to apply a minority interest discount and a lack of marketability discount. So instead of valuing your 40% stake at $4 million, you might value it at $3 million, which is, for all of you math nerds out there, a 25% discount. That means you can transfer $4 million of value while only using $3 million of your gift tax exemption. This works especially well with family limited partnerships and LLCs. You can transfer your business interest or real estate to your kids at a discount, which lets you move more wealth out of your estate without triggering gift taxes. You need a qualified appraiser and a good attorney to do this right, but it's one of the most powerful wealth transfer strategies out there. Look, I've been doing this for a while now, and I've helped families in North Carolina, South Carolina, and California protect over $50 million in assets from unnecessary taxation. I've seen what happens when people wait too long. I've seen families lose millions because they didn't plan ahead. And I've seen relief on people's faces when they realize they can actually control what happens to their wealth. This stuff works. It's not theory. It's not some sketchy loophole. It's just smart, legal tax planning using tools the IRS explicitly allows. You just have to know they exist, and you have to set them up correctly. All right, here's the bottom line. You've built something, whether it's a business, a real estate portfolio, or a lifetime of smart investments. So you didn't do it so the IRS could take half when you die. Good tax planning isn't about cutting corners. It's about using the tools the law gives you to protect what's yours. At Rankin Law Firm, we help business owners and high net worth families build estate plans that actually work. Plans that save taxes, avoid probate, and protect your wealth for the next generation. If you want a plan tailored to your situation, schedule a consultation with us today. We serve clients in North Carolina, South Carolina, and in California. Links in the description. And if you found this helpful, subscribe for more straight talk on estate planning and wealth protection. Don't leave millions on the table. Plan ahead. I'm JP Rankin. Thanks for watching.